Ross is the Chief Economist with the Australia's World Grains Innovation Centre. That's a joint initiative of the WA Department of Agriculture and Food and the Grains R&D Corporation. He's also a professor in the School of Agricultural and Resource Economics at the University of Western Australia. He serves on a DAF Expert Advisory Panel, and he also chairs the Australian Farm Institute's Research Advisory Committee. He's been co-editor of the Australian Journal of Agriculture and Resource Economics, president of that same society, and is a distinguished fellow of that society. And in a recent book, which I think is quite interesting, on the history of the Department of Agriculture in Western Australia, he's listed as one of its 50 most historically influential people. I don't know whether that means he's already historical or whether he's just influential, but he's been researched and interests in farming systems and the whole business of farming for a long while, and so that's taken him around the world. So please welcome our second speaker, Ross King.
Okay, so I'm going to, given the lateness of the hour, I'm going to meander a bit and probably have a more conversational presentation. So it won't be mentally taxing and it'll tread over some ground already covered. So what I want to do is talk a little bit about some general findings regarding returns to family farming. So the first chart that I've put up here is a chart that looks at ABARES AgSurf data, and it looks at the rate of return that includes capital appreciation to Australian wheat farms and Australian mixed farms. And the first point that I want to make, which is a very obvious one when you're looking at family farming and you're looking at the attractiveness of investing in farming to an external investor, it's when you invest is incredibly important. So if you invested during the blue box time, if you're a short-lived investor, then your conclusion would be that that investment in farming was very profitable. Conversely, if you entered farming after the GFC, your conclusion might be that agriculture was not particularly attractive. The issue is, how do you know when to invest? So that's one complication. When do you invest? The second complication is, where do you invest? Because if you look at the spatial volatility in Australia, it can be pronounced both between years and even within a year. So this chart looks at wheat yields in agricultural shires across Australia last year. And it's very obvious from that what the huge spread of wheat yield is in this single production year. So you really can't say, oh, X year was a fantastic year. That may be true of one location, but you don't have to necessarily travel far to have the complete opposite conclusion. So last year was a fantastic year in many parts of southern Western Australia, in South Australia, less so in northern New South Wales and Queensland. If you took a single year, and this is the year 2007, in the northern grain belt of Western Australia, that was a decile 1 rainfall year, one of the worst years experienced. And you only had to travel a few hundred kilometres south and you would be on farms that were having some of their best yields ever. So this is the spatial volatility that affects an external investor. Where and when is it best to invest? Completely different outcomes in a single year, in a single state. Then there's the difference between years. So again, here's consecutive years. 2010, worst drought year on record in Western Australia. The following year, one of the most high-yielding years on record. So this is the story not only of spatial volatility, but it's also the story of temporal volatility. And for risk-averse investors, that makes investing in broadacre agriculture fairly unattractive. So there's climate volatility. Then there's price volatility. Again, huge volatility both within a year and across years. So each of these coloured lines is the FIS APW wheat cash price at Kwinana. Even within a single year, marked price volatility, and wheat growing is the main agricultural enterprise in Western Australia. So it's a main enterprise that is underpinned by marked volatility in price. And if you combine price and yield together to look at revenue, and you compare Australia with other countries, then you find that Australia has marked revenue volatility. We don't have crop insurance products. We don't have guaranteed prices. So when you look at the proportion of that revenue variability that is attributable to yield, you find that yield variance is the principal driver of revenue variability in wheat production. So price is important, but it's actually yield variability in Australia that drives a lot of the revenue variability. And that variability has increased through time. So if you looked at the period 1973 to 1991, and you looked at the risk components for wheat revenue volatility compared to a later period, 92 to 2006, the size of the pie has increased. That is, overall volatility has increased. And in that particular period, and this is the period before the price spikes in 2007 and 2010-11, then yield variability was more important. That's less so when you lengthen the data set for subsequent years. But the story remains true that if you're running a business in Australia, you're looking at a business that's underpinned by marked revenue volatility. So if you're going to make money in agriculture, it pays to be a patient investor, because you're never quite sure about when might be the exact time to invest, and even understanding where to invest is not always transparent. And increasingly in broadacre agriculture, a lot of the investment that is occurring at the farm level involves commitment to some very long-lived assets that need a fairly lengthy horizon to generate returns. So, for example, this is a farmer, Brad Jones in Cannon. This is much larger than his neighbours with respect to the investment in grain storage, but it's increasingly typical that farmers are making investments in some very long-lived assets, and therefore they need a fairly long time to generate returns from those. The other aspect of why patient investment is needed is that in Australia there's very little ability to farm the public purse. That's fairly obvious, but agricultural investments in many other countries are underpinned by significant benefits that flow from the public purse. That's not the case in agriculture. In fact, if anything, our agriculture is exposed to decisions that don't necessarily improve agriculture or protect it, but in fact worsen it. The decision regarding the banning of live cattle exports to Indonesia is an example of a government action that was hugely detrimental. Decisions about animal welfare, again, if they're made too hastily, with the adequate time for adjustment, then they can impose particular costs. This is the equivalent of a conference that might be held in a farming region. So our conference title is Funding Agriculture's Future. Well, this is the grassroots equivalent. This was a conference that I spoke at last year. And for a lot of farm families, securing their funding is unfortunately often done in a way that paints agriculture in a negative light. That when things get tough, large gatherings of farmers occur to either criticise banks or to force politicians into action as a way of supporting the farm businesses. So this was a case of over 800 farmers in the eastern wheatbelt of Western Australia. It was a gathering that was supported by Raoul Bolton and Bob Catter. And again, no surprise here that at such gatherings occasionally self-interest is at work. Raoul Bolton declared a bankrupt a few months ago. So we need to be really careful when we're talking about agriculture, how we talk about it. And I want to talk about it in a way that is hopefully both honest, but also shows some of the potential available to patient investment in family farming. And what I want to do is tell you the story of 270 family farm businesses in Western Australia that we tracked over a decade. So these were the same farm businesses that were followed from 2002 to 2011. And if you look at the annual growth in real wealth of those 270 farms, and these were typical farm businesses, what you find is that over that decade, 1 in 6 of them were actually worse off at the end of that decade compared to the start. So they actually eroded their real wealth. A quarter of them generated rates of real return of over 6%. This is a real rate of increasing their wealth. And when you plot them, this is what you find. So here's 270 points. This is a decade's worth of farm family experience. And again, no surprise here that where the high rates of real return are being generated, that's typically associated with high variability in returns. The point to stress here was made by Graham McConnell in yesterday's first session. If you look at the nature of that variability, what you find is that it's mostly upside variability. That those farmers who are able to generate higher rates of return, so that's that group that, if you like, sit in ABARES top 25% group. If you have a look at that group, typically what you'll find is that in their poor years, they are not disastrous years. These are farmers that manage downside risk very well. But more importantly, they manage upside risk incredibly well. So they end up with a highly skewed distribution in their returns. So their average returns are high, but the variability is high. And the variability is high because they experience a lot of upside. So some people think of risk as being downside risk. Risk can also be upside. And the nature of family farming, certainly in this sample set, is that the variability is due to the performance of farms with respect to their upside. What I want to do now is unpick that data set, because one of the findings is that if you analyse that data set and ask the question, why do some farm businesses perform well and why do some not, and do statistical analyses on this, unfortunately, the main finding is that a significant explanator of farm performance is what we call the farm effect. That is, it's the unique characteristics of that farm business that most determine its outcomes. So that means it's very difficult to draw easy generalisations. So if you performed well, that could be due to where your farm is, it could be due to the nature of seasons that you've experienced, it could be due to your enterprise mix, your soil types, your labour availability. So there's a very complex set of ingredients that sit underneath high-performing farms. There are some generalisations, and I'll talk about those in a few minutes. But if I had to give an overall comment, it was that the nature of farm performance is mostly due to the unique characteristics of that farm business. And so one of the ramifications of that, that if you want to improve farm performance, it pays for you to know the nature of that farm business. And so for me, it's no surprise that in Western Australia, for example, a lot of farmers do have farm management consultants. Because these are people who know those farm businesses, and because they know them, they are able to give advice that drives those businesses forward. They understand the unique characteristics of those businesses. So I want to just talk about how sometimes your region is your destiny. This is getting to the earlier question of where do you invest? So I want to contrast the eastern wheat belt with the south coastal area. And if you look at those sets of farms and how they perform, then you get this. So that the red dots are the eastern wheat belt and the blue dots are the south coastal area. And a few observations here. The eastern wheat belt, now remember that's where that big group of 800 farmers gathered together. The eastern wheat belt over that decade, about 40% of the farms at the end of that decade were worse off than at the start. So it's no surprise that farms gathered in that region because they were financially distressed. And it almost didn't matter how good a manager you were, if your farm was in the eastern wheat belt, then your rates of wealth appreciation were going to be highly constrained. By contrast, in the south coast that had more frequent favourable years, then the spread of farm performance was much greater, and the ability of a farm manager to extract value out of their farm seasons and their farm structure and operation was much greater. So those businesses were looking at a lot more upside opportunities, and the better managers extracted a lot of value out of those years. By contrast, I've given there the green triangle is the all ordinaries. So that's how the all ordinaries went over that same period. And if you deflate the all ordinaries by CPI, so if you say let's express the all ordinaries in real terms, then it was not that flash. So even when you include dividends on top of the all industries index movements, again you would have to say that here is an example where investing in agriculture over an equivalent period was very attractive. Now, I'm sure Sash would say that's entirely a product of the duration of observations, and that's true. If you lengthen the period of observations, then you will find the ordinaries improved more. But having said that, farming also has done incredibly well. Last year was the biggest crop grown on record in Western Australia, over 16 million tonnes, and was shown by Graham. Last year was a fantastically profitable year, so much so that a lot of farmers were able to pay off debt. So even including later years, I suspect you would only find higher rates of appreciation of these farm businesses. What are some generalisations? Why have these farm families performed so well? So what are the characteristics of the high performers versus the low performers? I've said region is important. If you disregard region and just compare farms within each region, so comparing like with like, and say what characterises farmers, typically what you find is it's really reflective of, again, of what Graham was saying, that the little things matter. The better farmers achieve more grain yield per millimetre of growing season rainfall. So they are just able to extract more yield per millimetre of rainfall. And they do that, and we've looked at the data, they do that by being more prepared. So they are really prepared to timely plant and harvest their crops. They are not only better crop managers, but they're also better livestock managers, in that the income that they derive, again, per millimetre of growing season rainfall out of their livestock enterprises is more than those that are, if you like, in the bottom 25%. So overall, they are better managers. They tend to run more crop-dominant systems. As Graham was showing, they do get slightly better prices for their commodities, but it's more to do with their agronomic management. They are just highly skilled at doing things really well. Yes, they pull their horns in, like most farmers do in their poor years, but they manage that upside incredibly well. And because they manage the upside incredibly well, it typically means that they are able to grow their businesses more quickly and better. The farmers in this sample tended to lease more land than necessarily buy land. So for some of these farmers, their expansion path was through leasing or through land acquisition. So the story here I want to paint is a pretty positive story. A lot of people paint the returns to agriculture in pretty bleak, volatile fashion, whereas this analysis is showing that at least over a decade, there's a typical group of farmers that are consistently able to achieve very high rates of return. And they do that by virtue of their management skill. So a question really is, if the main ingredient is management, then how do we ensure the maintenance of those highly skilled managers? One of the things that we did find, for example, was that group were able to adopt and utilise cropping innovations. So these were people who tended to be fairly well educated. They were very savvy when it came to assessing and testing new technologies, and they were really skilled at, if you like, choosing to adopt profitable technologies. So how do we ensure those farm managers of the future continue? And for me, that's really a crucial issue. There's no shortage of agricultural land. There's no shortage of investors. I tend to agree with earlier comments that I think what most determines the profitability of a lot of agricultural investments is the skill of the managers. And so the question is, how do you retain and find and replenish that pool? Because that's the very pool that needs to drive the profitability of the agricultural sector forward in coming years. So it's not finding the money, it's not finding the land. I suspect the next big challenge is the human capital base that sits beneath successful farming. And how do we invest in that? So these are my findings, that investment yield and volatility are positively linked, but don't be concerned about that, because the volatility tends to be more upside. I do use the term dry land. Dry land farming investments do face a range of challenges, but the evidence is that farm businesses are well equipped to deal with those risks. They do manage those risks well. They generate high returns in spite of lack of government support that is available to our competitors. And that they are not necessarily low return, high risk investments. It is quite moderate risk. Thanks.